In this video, we will continue discussing the topic of risk management in a company and will concentrate on specific types of risk to which organizations are exposed in their international activities. Those risk types are political risk, economic risk, regulatory risk, and fiscal risk. In just a moment, we will attempt to define each of the risk types and present how companies can manage exposures resulting from those risks. Political risk is associated with the instability of government in the country where a company decides to locate a subsidiary. This risk is defined as the negative impact of decisions taken by local policymakers on the value of a company. Examples of extreme cases of political risk include the outbreak of war or the expropriation of a company's assets by a foreign government. However, the spectrum of threats to companies located in foreign countries is much broader. Examples of these include imposing tariffs or quotas on imported goods or restrictions regarding the remittance of cash to the parent company, as well as special rules on the dividend policies of foreign entities. Local governments may also implement discriminatory regulations aimed in particular at foreign investors, such as limitations on access to local financing sources or super taxes imposed on foreign firms. Political risk may be divided into micro risk, which relates solely to a given industry or sector, and macro risk, which affects all foreign companies present in a given country. Due to its complex nature, there is no way to measure political risk. However, there are rules which companies interested in locating a subsidiary in a given country may use in order to assess its level, such as the information provided by rating agencies. An alternative approach to the measurement of political risk involves the use of quantitative methods based on macroeconomic modeling or real option valuation. Another method used by organizations considering locating an investment in a given country includes consulting experts such as academics, diplomats, or businessmen already present in the local market. A measure which is often applied before an investment decision is made is a grand tour, which is an inspection of the locations considered, tied to meetings with local government and aimed at gaining an understanding of the specifics of doing business in a given country. Finally, companies may use information provided by commercial political surveys, which assess the level of political risk of countries on a numerical scale, based on questionnaire data. Such survey-based information is, for example, offered by Business Environment Risk Intelligence or the Political Risk Services Group. Management of political risk has two aspects. The first one includes actions that may be taken by a company prior to investing in a country, and the second one consists of measures which a company may put in place after a subsidiary has already been set up. Among the actions typically taken in the pre-investment phase is the signing of a pre-trading agreement with the government of the host country. The aim of such an agreement is to contractually regulate and thus stabilize the factors which are deemed critical to the functioning of the subsidiary, such as rules related to dividend policies and the remittance of cash flows. It should be noted, however, that there is a risk that pre-trading agreements may stop being recognized in the case of a change of government, which may be a frequent occurrence in unstable host countries. Another way to reduce political risk in the pre-investment phase is by transferring it to another entity via an insurance policy, such as export credit guarantees. After a subsidiary has been set up in a country, the investing group typically attempts to stabilize the level of political risk by managing its relations with government and market participants in a way that will discourage local policymakers from taking decisions which could negatively impact the foreign entity's business. The aim is to convince decision makers that the local economy, society and government actually profit from the presence of foreign investors in the country. This may include emphasizing such factors as contracting local resources and labor and obtaining funding via local financial markets. On the other hand, companies may also take actions aimed at lowering the value of their overseas subsidiaries as perceived by local governments in order to deter them from attempts to expropriate those subsidiaries' assets. Such actions include locating critical value-adding production stages in the home country, holding control over distribution networks, and protecting intellectual property with international patents. Moreover, companies may finance their subsidiaries via international financial markets, which should protect assets from expropriation because a potential default in the servicing of debt would expose the local government to criticism from international financial institutions. Another type of risk which is connected with overseas investment is economic risk, defined as the volatility of a company's value due to changes in the macroeconomic environment of the host country, including factors such as economic growth, recession, and unemployment rates. Having said this, the single most important factor which influences economic risk is the level of the exchange rate of the local currency, which directly impacts the profitability of imports and exports of a foreign company, and in particular the level of dividends and other cash remittances made to the parent. Although it is similar to transaction risk, economic risk is typically not hedged with derivatives, but rather managed through the diversification of supply, distribution, and financing sources. As you can expect, when a company's sources of supply as well as its buyers are spread across different geographical locations, then the negative impact of the weakening or strengthening of one currency should, at least to some extent, be offset by an opposite change in the rate of another currency. Similar effects may also be observed when the sources of a company's financing are diversified internationally as well. Regulatory risk is similar to political risk because it materializes through decisions of local policymakers regarding specific requirements relating to a given industry or market. New regulations may be of a general nature that is related to all entities in a given jurisdiction, such as anti-monopoly laws, or of a specific nature, which means that they are aimed at certain industries only. For example, new regulatory requirements related specifically to the banking sector or to health services. There is no simple recipe for managing regulatory risk. Typically, companies maintain compliance teams which analyze planned and announced regulatory requirements and assess their impact, project the necessary implementation actions, and compute the cost of conforming to the new laws. Alternatively, companies may hire external consultants to perform these tasks. A similar approach is applied to fiscal risk, which represents the uncertainty related to unfavorable changes in taxes levied in a country where an overseas subsidiary is located. Management of fiscal risk includes primarily keeping track of changes in a country's tax system and making sure that the policies followed are up to date. As with the management of regulatory risk, this may either be done in-house or be outsourced to external tax consultants. As you can see, the spectrum of risks associated with the presence of an organization in a foreign market is wide. These risks are interconnected and complex in their nature, which is particularly true for political and economic risk. You should appreciate that the list of risks discussed in this video is far from exhaustive. In fact, the range of risks to which firms are exposed in their international activities is widening. Terrorism and computer network security are examples of risk categories whose importance in investment decision-making has recently been on the rise. We must therefore keep in mind that risk management is by its nature a dynamic process where risk exposures should constantly be tracked and analyzed and policies updated. As we have already mentioned, the risk types which we discussed in this video cannot simply be hedged, as is the case with market risks. The management of these exposures must be part of a company's strategic decision-making process, rather than relying on a day-to-day management approach.